and welcome to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. As you know, on this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Joining me today for our 100th episode of this podcast is Scott Wood, our Chief Investment Officer. He is one of our most attended guests. We have him join us a lot. And today we're going to talk about the economy and see what's going on. So, Scott, you got to tell me, what is going on in the markets right now?
Yeah, thanks, Jaime. Congrats on 100. That's a big deal.
Thank you.
Yeah, the markets have been going crazy here recently. I don't know if I'm sure everybody's been paying attention to your 401ks and the investing you're doing, as well as on the bond side of things. The markets have been very choppy, very volatile. Lots of volatility. We've had these AI stocks that have been really going higher and higher in valuations. Mm-hmm. And then in the last couple of weeks, there's been a lot of questioning, like, is this going to be sustainable? I think NVIDIA was a big one, right? NVIDIA earnings came out, and they were actually pretty good earnings, but maybe slightly weaker than some people were thinking. So that moved AI stocks lower. The bond markets have been all over the place because the markets are trying to figure out what's going to happen with rates. What's the Fed going to do? And I would say the markets have had kind of their own thoughts about this for a while now. They've thought that the Fed should have been cutting rates a while ago, and they should have been relatively aggressive. If you remember, when we came into this year, they were pretty aggressive on their forecasts. Yeah. They backed off a little bit when we got that little bit of bump of inflation again earlier in the year, when it kind of was stagnant, went up a little bit. But really, the markets have been on this tear, begging, practically begging, or trying to coerce the Fed into cutting rates. So we've got that aspect of things where people are trying to get a feel for where we're at in the economy, what's going on, because some of the data has been showing a little bit of weakness. We've had some global issues. China has been one of those where there's been a lot of weakness in China. They're a big driver of the global economy because they produce so much. So that's been weighing on people's minds. But really, it's really been this higher rate environment that we've been in for a while now. People think we're at the turn, that things should be happening. So I think it's created some volatility. Okay. And maybe some passiveness too, with people in their investing in the equity markets, where they've been, something like NVIDIA, where they've been bidding it up to, I think when I looked at the PE ratio a couple of weeks ago, it might have been 55 to 60. Now it's down in that 50, low high 40s, low 50 range. Palantir is another one that's been screaming. And then, some of the big tech guys, the Googles and the Amazons and the Apples, who have been really been driving this upward move in the equity markets. There's just been people starting to question, this AI has been the recent driver, and it's like, okay, we really haven't generated any profits from AI yet. And what is the what's the prognosis for that? When do we anticipate that there's going to be? And because these big firms are pumping in a lot of money.
Yeah, they are.
Into AI and getting prepared for this, what they see as the future. And so I think the markets are just questioning a lot of things right now, questioning where rates are at, hoping the Fed's going to start cutting real soon. So all this playing together.
Yeah, I think we're all questioning a lot of things right now if we're looking at some of our own portfolios.
Yeah, there's a lot of questions out there.
All right. So the Fed, they meet next week. So the last time, you and I talked, you were anticipating a drop in rates here at the September meeting. Will we see that next week? And if so, why?
Yeah, so the Fed does meet next Wednesday. Well, they meet Tuesday and Wednesday. It's a 2-day meeting. So September 18th is the day that they're going to come out with their announcement. So this it's kind of a pivotal meeting for a number of reasons. One, highly anticipated on rate cuts. And just to get straight to the chase, the Fed's going to cut rates at this meeting. And there's no question. They've laid the groundwork for that at the last meeting. And then since the last meeting, Chairman Powell at the symposium out west, he basically said, we're going to cut rates. He didn't give a magnitude of what they were going to do, but he said, basically Jackson Hole, he said, we're going to cut rates. After Friday's jobs report, the vice chair, John Williams, who was the New York Fed president, he also said it's time to start cutting rates. Again, no magnitude, but saying, hey, at that September 18th meeting, we will be cutting rates. So expect the Fed to move at that meeting.
Okay.
So then the question is, what's the magnitude of that rate cut? So there's been a lot of debate in the markets. So there's a lot of people calling for 25, a lot of folks calling for 50. It's really been a split. When you look at Fed fund futures, the markets are saying they're giving 100% odds of a 25 basis point rate cut. So that's clear that that's going to happen. But then they're about 50% odds that we'll see 50 versus 25. So another 25 basis points of that meeting. So that's the question that we have before us today. We had jobs report data on Friday. The data was actually not too bad. The unemployment rate fell from 4.3 to 4.2%, which was positive. That was anticipated, and it was a positive thing. There was over 100,000 new jobs created. The issue was there were some downward revisions to the prior 2 months of jobs. So that was revised slightly lower. But and then earnings were a little bit stronger than expected too, which could impact inflation. So all in all, it was kind of a mixed Goldilocks type of report. It didn't lean one way or the other. Like the 50 basis point cut, people were hoping that it would be kind of an ugly number and that the Fed would be forced to say, okay, employment is really deteriorating quickly. We need to go ahead and cut by 50. They didn't get that in this report.
Okay.
So really, I think Friday's report gave a lot of credence to the 25 basis point rate cuts at this meeting.
All right.
So we're going to get a rate cut, and then the Fed's going to give us updated projections for the dots plot and their economic projections, for the next year plus. So we'll have an update from them on that too. So that's important to give us an idea of where we're heading. We're in budgeting season, credit unions are. So this will give them some good ammunition, an update with current economic data, kind of let us know what the Fed's thinking about how aggressive they're going to be on cutting rates, at least what their median projections are is something to pay attention to.
All right. So we're looking at a rate cut, definitely 25, maybe 50. So if after that happens, do you anticipate maybe another rate drop later this year?
Yeah. And so my bet is 25 basis points at the September 18th meeting.
Okay.
And then we have 2 meetings left for the year. We have a November meeting and then we have a December meeting. The November meeting is November 7th. So it's the day after the election. There's a chance the Fed could cut then, and then December also. It's really hard to know what that number is going to be because they're continuing to make decisions as they tell us based on incoming data. So we'll have to see how inflation holds up. There has been a slight uptick in used car prices recently. There's been a slight increase in wages above what we anticipated, but really we're not expecting really any movements material higher anyway on inflation. So we're probably pretty contained there, barring something unforeseen. So it's really going to be the employment data and what that looks like. So, that comes out the first Friday of every month. Mm-hmm. So we'll have another couple of readings before, but I would say we're going to get at least another 25 basis point rate cut after September, whether it's November or December. And there's a chance we could get 25 at each meeting. Yeah. I'm thinking 50 total between, September and the other 2 meetings, but 75 is certainly in the realm of possibilities. And when you look at the markets right now, they're predicting between 4 and 5 25 basis point cuts this year. So they're predicting 100 to 125 basis points of rate cuts. I'm in that 50 to 75 basis point rate cut camp for the rest of the year.
Okay. All right. Well, as we both know, credit unions, they're in the business of lending money. So, how are the auto and mortgage markets looking right now, and what impact could there be to the credit unions?
Yeah, and I think, some of the impacts have already been felt, unfortunately, and there's maybe some more pain to come for some credit unions. So what we have seen here, especially in the auto market, has been rising delinquencies. There have been more people late on their payments. When you look at the data, the New York Fed publishes quarterly data on basically the condition of the consumer, what they're borrowing, how much credit's outstanding, and how payments on that credit is going. They'll publish 30 and 90-day delinquency and default rates. The trends there with autos and credit cards have certainly been trending higher. For a while there, we were trending higher, but still below pre-pandemic numbers, before the pandemic hit. In a lot of cases now, we're above those pre-pandemic numbers on delinquency. So people have been slower to pay in those two areas. We've also seen some upticks in mortgage delinquencies, which is a little surprising because there's a lot of folks out there that have really low mortgage rates, but we have to consider there are a lot of people that bought houses when mortgage rates were higher, when the Fed started to do their movements. So some of those folks out there, and some people actually bought ARMs when we were in that process of moving higher. So some of those things have led to delinquencies in both of those, autos and mortgages. The good news is we monitor this internally. We have a credit officer who monitors this for us for our portfolio, and we're starting to see some stability in the auto delinquencies. So we're starting to see those start to stabilize a little bit. And if the Fed is on top of this cycle right now and they start cutting rates, then that should help improve things. It should make things better. It should mean fewer job losses going forward. They may engineer that soft landing. So that's all positive. I would say the good news for credit unions is with the Fed getting ready to lower rates and market rates coming down, what it should mean is more opportunities. There should be more auto purchases. We have seen an uptick in auto purchases this year, both new and used. So that's a positive thing for credit unions. It gives them the opportunity to generate more loans. There are also going to be some opportunities to refinance loans, whether it's mortgages or autos. Some people that have these, 6 or 7% autos, they may want to refinance if they have the opportunity at, 3.5, 4.5, 5%, wherever we get to. So there's opportunities there. Of course, the flip side is some of those opportunities may be your own loans that you're refinancing from a higher rate, and your member says, "Hey, can you do this for me? If not, somebody else will." So you may be refinancing some of your own loans, but it also gives you the opportunity to generate some additional volume. So as rates go lower, those are the opportunities that are available. So it's positive. The negative, though, obviously, is the trend of rising delinquencies, and that bears keeping an eye on here. The state of the consumer is kind of uncertain at this point. It seems like there's two camps, and we've talked about this on prior calls. There's a group that are kind of really struggling using credit cards to pay those normal monthly bills, food and things like that they need. So they've been struggling, and credit. We see that with credit card balances they're at all-time highs, over $1 trillion. So that is a concern, but then there's another part of the economy that's doing very well. These savings have increased. They've been able to absorb these higher prices, and they're still spending money, so they're still keeping the economy moving along. So kind of a mixed bag right now.
Okay. Well, Scott, we're coming to the end of these summer months here. How are credit unions faring in regards to liquidity?
Yeah, liquidity has been a pretty good bright spot. I think liquidity's held up pretty well for credit unions. No, we're just escaping these summer months. And, from Vizo, we aggregate, right, all the credit unions' deposits, so they keep with us. So we kind of see these normal trends. And September is normally the last month where we start to see balances dropping. And that's probably summer ending in August sometime, maybe vacations and things were on credit cards, and then they make those payments in September when the bills come due. And then after September, we start to see balances increase, basically through the end of the year. We may see a slight downward trend in December, but we've been seeing these trends. They've been on trend, maybe slightly better than we've seen historically, but credit union liquidity has held up pretty well. We've seen credit unions doing some good investing here recently. Investing's been pretty strong. So far, so good. If the Fed cuts rates, that may be another positive thing to help liquidity out a little bit more too. So far, we've been holding up pretty well.
All right. So we got a few more months left in the year. What else should credit unions be looking at in the months to come regarding the economy and the markets?
Yeah. So Tim and I have talked about this in these calls in the past. The big thing is just to listen to the Fed. The markets have had their own idea of what the Fed should be doing, but the they've been pretty transparent, telling everybody what they're going to do. And I think they continue to be transparent. So continue to listen to the Fed and what they have to say. Obviously listen to at the FOMC meetings, but then you'll see these headlines from different Fed members, especially when it's, one of the voting members. Pay attention to kind of what they have to say. The thing that I would keep a real close eye on here over the next few months is, and maybe the next year, is really employment data. So the Fed told us at their last meeting, the balance has shifted, the risk has shifted to more a balanced approach. So they had been really concerned about price stability, inflation. That was one part of their dual mandate. And that's what really led them to the increase in rates. Last Fed meeting, they said it's more balanced now. So their concern was not solely or predominantly with inflation. It was also with maximum employment, the other part of their mandate. Mm-hmm. And that's really where the focus is now. The Fed feels really confident that they're going to get to their 2% target. Okay. We're not there yet, but inflation continues to track lower. So the Fed and Powell has said this, he's very confident in the direction we're going and that we're going to get there. But the concern right now is employment, and does it deteriorate? You may have seen 3 or 4 weeks ago, they came out, the Bureau of Labor Statistics, and they said basically that there's probably going to be revisions for the past year of over 800,000 jobs lower than what was originally reported. So that'll impact, not quite 100,000 a month, but that's a negative trend. That's a negative thing. And it's because they do all these adjustments with the statistical data. They do seasonal adjustments and everything else throughout the year. And then they realize they had over adjusted. So they're going to be probably 800,000+ jobs were over reported. I told you the Friday jobs report, the most recent one, showed a revision lower for the prior 2 months. So just continue to keep an eye on those two components of employment data. The first Friday of the month is when they come out. So pay attention to the unemployment rate and the number of new jobs created. And then every Thursday morning, we get the claims data, initial jobless claims and continuous claims. So pay attention to those initial jobless claims too. If they start to trend higher, that's certainly an early sign, because those are a week delayed. So that's a pretty early sign to pay attention to, and it'll let us know if the economy is weakening. That's where you should be more concerned. If we start to see employment weakening, then you can expect that your delinquencies are probably going to pick up, because some of your members are going to lose their jobs. The flip side of that is your liquidity is probably going to get a lot stronger, because people, even if it's not impacting them directly, they tend to start saving money in anticipation that it could be them next. So they'll start saving cash. So those are the two things I would be aware of. And yeah, I'd really keep an eye on the employment data. That's kind of the Fed's focus right now.
All right. Well, Scott, thank you so much for joining me. Any final thoughts for our listeners today?
Yeah, I think other than what we've already talked about now, I would say, that the Fed may have engineered a soft landing. The data right now looks like the Fed may have engineered a soft landing. I've been very skeptical about this really since the get-go, and it's really because they were so aggressive, right?
Yeah.
They did 25 and then 50, then they were 75, 75, 75. We had the quickest pace of tightening, at least initially, ever by the Fed. They were really aggressive really quickly, and it didn't seem likely that they could engineer a soft landing. Now, I'm not saying they're out of the woods yet and they have engineered a soft landing, but the data today looks pretty convincing that that's what they're going to do, as long as they can get on top of this, assuming the jobs market is deteriorating, and it is. It just depends on how rapidly it is. It doesn't appear to be very rapid, really, because we have a lot of spending going on. So kudos to the Fed if they actually did engineer a soft landing. Again, I would give it another few months before I'm in that camp to say, you know what, they did it. But things are looking pretty good right now. I mean, overall, certainly there's some issues. There's some worrying signs with employment. There's some worrying signs with debt, delinquencies. And then when the Fed does start cutting at the September meeting, it generally is understood that it takes 6 to 9 months for those rate changes to feed in fully through the system. So it's going to take a little bit of time. So I'd say once the Fed does start cutting rates, it's not going to be an immediate impact. It's going to take time to have an impact in the marketplace. So the hope is that we hold on, that things continue to hold up well. And then the wild card through all of this is November 6th. We have a presidential election. And I think the jury's still out on who's going to win that race. There's not a clear-cut person right now who has a clear lead that, a month or two ago after the debate, it was pretty clear that one candidate had a lead over the other, and you could start to say, okay, what are the policies going to be and stuff? We don't have that today. So it's really hard to know what the policies may be or the preferred policies going forward. So we'll have to wait and see. That's obviously could throw a wrench into things. And no matter who wins, there's going to be a lot of upset people on the other side. And hopefully that doesn't lead to anything too negative. I don't think either one of them has anything that economists thinks is going to kind of rock the boat and disrupt the economy to an extent where things are going to slow down because of that. It's really what's already in motion kind of thing. So yeah, tighten up and see what happens.
Always interesting, isn't it?
It'll be interesting to see what happens. Yeah, for sure.
All right. This 100th episode of Financial Minds with the Experts is brought to you by Vizo Financial's ALM Direct Modeling. As the financial industry changes, balance sheets are becoming more complicated, new regulation requirements are being created, and credit union staff are being challenged by the need to devote increasing time and resources to ALM management. Vizo Financial's ALM Direct Modeling solution can help ease these burdens. Let Vizo Financial be a trusted resource to process your data and perform modeling, while also giving you the ability to test rate strategies or perform what-if scenarios whenever needed. Want to know more about Vizo Financial's ALM modeling service? Email almservices@vfccu.org. As always, thanks for listening and make it a great day.